Ladies and gentlemen, we live in a world built on illusions. We use money that isn't really money. We consume news that often isn't news. And in the silver market, we rely on an inventory report that may be the greatest work of fiction since Harry Potter. For years, bank apologists and market bears have clung to a single number to convince you that silver is abundant. They point to the total COMEX inventory and say, look, there are hundreds of millions of ounces in the vaults. There is no shortage. Anyone who disagrees is a conspiracy theorist. Today, we tear that illusion apart. We pull the roof off the warehouse and expose the secret hidden in the footnotes. The entire deception hinges on two words most people ignore: eligible and registered. If you don't understand the difference, you're staring at a mirage and calling it an oasis. Here's the terrifyingly simple truth. The silver you see on the headline report is not for sale. The total inventory number is a distraction designed to suppress price signals. The only number that actually matters, the one that determines whether this market survives or breaks, is flashing red at historic lows. The vaults are not full. For all practical purposes, they are empty. COMEX divides its silver into two categories. Eligible silver meets the exchange's purity standards and sits in approved vaults like Brinks or Loomis. But eligible does not mean available. That metal belongs to someone, a private investor, a bank, a family office, or an ETF like SLV. It is merely stored there. It S like a car parked in a public garage. Its presence doesn't T mean it S for sale. Registered silver is different. Registered silver has a warrant attached. It is the only metal actually available for delivery against a futures contract. If someone stands for delivery, this is the pile they draw from. 5 years ago, that pile was overflowing. Around 150 million ounces were ready for sale. The market had slack. Today, that buffer stock has collapsed to roughly 40 million ounces. In a global market where billions of dollars trade daily, that amount is a rounding error. It's less than 2 weeks of global mine supply. Less than what a single major industrial user can consume in a year. The shock absorber is gone. We are speeding down a rocky road with no suspension. So why do bears keep pointing to total inventory? Because the eligible pile still looks large on paper, hundreds of millions of ounces. They claim that higher prices will magically pull that silver into the registered category. That assumption is the lie. Much of the eligible silver is owned by long-term holders who don't trust the system and have no intention of selling at $30 or $50. A massive portion belongs to ETFs like SLV, where the metal is legally ring-fenced. It cannot be sold into COMEX unless the fund itself liquidates. It appears a supply, but it is locked away. Then there's the encumbrance problem. In high finance, a bar of silver is rarely just a bar of silver. It may be leased, pledged as collateral, or rehypothecated multiple times. One institution owns it, another leases it, a third has a claim against it. Who can sell it? No one. That bar sits frozen in the eligible column, counted as supply but incapable of moving even at extreme prices. High prices don't unlock encumbered metal. They expose how inelastic the supply really is. Meanwhile, the registered pile, the only real supply, is being drained. We see loadouts, the final stage where trucks remove bars from vaults and the metal disappears from the system entirely. This tells us everything we need to know. The biggest buyers no longer trust the exchange. They want possession, not promises. Think of it like a supermarket where the shelves look full, but every box is a hollow display. The real food is on a tiny shelf in the back, and hundreds of people are lining up. That back shelf is registered silver. Everything else is for show. The leverage is extreme. For every ounce of registered silver, there are dozens of paper claims. It's a game of musical chairs with 1 chair and 40 players. As long as no one demands delivery, the illusion holds. When they do, most players are left with nothing. This isn't hyperbole, it's forensic accounting. The illusion of abundance is carefully maintained to prevent panic. If the world understood how little silver is actually for sale, prices wouldn't drift. They would gap violently higher. Scarcity drives value, so scarcity is hidden behind the eligible mask. But the mask is slipping. Cash assumes choice, and markets assume availability. When the product no longer exists, money is rejected not by law, but by reality. The registered inventory is the fuse. When it burns down far enough, the explosion won't be subtle. It will be heard everywhere. We know that ultra-wealthy investors and family offices have been quietly moving massive amounts of silver into COMEX vaults for storage, not because they want to trade it, but because facilities like Brinks offer maximum security. These people are not speculators. They are strategic survivalists with billion-dollar balance sheets. They didn't buy silver to flip it for profit. They bought it as protection against systemic failure. If the dollar weakens or collapses and silver surges, do you really think they'll sell their insurance? Absolutely not. The higher the price goes, the tighter they hold. These are strong hands. The shorts are making a fatal mistake. They assume that at $40 or $50, the whales will cash out. That assumption reveals a total misunderstanding of who today's whales are. They're not hunting a quick 20% gain. They're planning an exit from the fiat system itself. You don't sell your lifeboat because lifeboats become expensive while the ship is sinking. Now we have to confront the most dangerous issue inside the eligible category, rehypothecation. This is the part no one wants to talk about. There is growing forensic evidence that the same bars of silver are being counted multiple times. One bank lists it as an asset, another lists it because it's leased, a third lists it because it was promised allocation. This is fractional reserve banking, but applied to physical metal. It works perfectly, as long as nobody asks for delivery. The moment multiple parties demand the same bar, the illusion collapses. 5 claims, 1 bar. 4 people discover they never owned metal at all. This is why the vaults are empty thesis is so threatening to the system. It implies that major bank balance sheets may be overstating real assets by billions. If eligible silver is heavily encumbered or rehypothecated, then much of what is presented as liquidity simply doesn't exist. There's another problem most analysts ignore: time. Moving silver from eligible to registered is not instantaneous. It requires paperwork, new warrants, assaying, and vault processing. In a panic, the constraint isn't just supply, it's administrative throughput. Vaults can only process so much metal per day. In a fast-moving price spike, a 3-week delay is catastrophic. You can have silver that wants to be sold, but it's trapped in bureaucratic limbo while the market explodes higher. Authorized participants exploit this delay. They shuffle metal between eligible and registered to manage optics. One day, millions of ounces suddenly appear in registered inventory and prices ease. A few days later, that same metal quietly disappears back into eligible. It was never real supply, just a perception trick, tape painting, head fakes. But metal can't be printed. Every time this shell game is played, friction increases and the registered trend continues downward. What we're facing is a physical liquidity crisis. The paper market trades billions of ounces every day. The real deliverable market has maybe 30 million ounces available. That gap is unsustainable. Leverage is extreme. Elasticity is near zero. Encumbrance is everywhere. The owners of eligible silver are not going to rescue the shorts. They are the ones removing the chairs. When you see a headline number showing hundreds of millions of eligible ounces, don't see supply. See a locked vault with a warning sign. See private wealth positioning for a post-dollar world. The shorts are trapped in a room with a starving predator. There's food visible through the glass, eligible silver, but the freezer is locked and they don't have the key. The encumbrance trap ensures that when registered inventory finally hits zero, no backup supply arrives. Eligible silver just sits there, unreachable, while prices explode. Now we reach the point of impact, failure to deliver, or FTD, the nuclear event of the commodities market. An FTD occurs when a long futures holder pays in full and demands physical metal, and the exchange cannot provide it. Picture a delivery month where a major industrial buyer, say a consortium tied to electronics or battery manufacturing, stands for delivery on 5,000 contracts. That's 25 million ounces. Registered inventory is roughly 30 million. One buyer has just claimed more than 80% of all available metal. The shorts panic, warrants are transferred, trucks are scheduled. The buyer wants loadout, not storage. Vault operators begin pulling bars, but problems emerge. Some bars are tied up, some are under audit, some inventory counts were optimistic. Before the dust settles, another buyer stands for delivery on 10 million ounces. Now total demand exceeds total supply. The math fails. The vault contacts the exchange. The metal isn't there. The exchange calls the shorts. You guaranteed delivery. The shorts respond, "We assumed we could source it from eligible, but no one will sell." That's the FTD. In any normal market, selling what you don't have is fraud. In COMEX, it's handled with emergency clauses, force majeure, and cash settlement. The buyer is told, "We can't deliver silver. Here's your cash back at yesterday's price, plus a small premium." But cash is useless. They already had cash. They needed silver to keep factories running. Returning money is an insult. It is like paying for a wedding cake and being handed a refund on the wedding day instead of a cake. This is when the paper price dies. The buyer takes that $1 billion and goes directly to miners, refiners, and private holders. "I need silver now. I'll pay whatever it takes." Suddenly, there are 2 prices: the COMEX price and the real-world price. The market decouples. COMEX becomes irrelevant, a paper casino. Real price discovery shifts to the physical market, and physical prices trade far above paper. Once delivery failure is proven, trust evaporates. Why would anyone sell silver at $30 on COMEX when real buyers are paying $50 or $60 on off exchange? They wouldn't. Volume collapses. Open interest vanishes. Lawsuits follow. Investigations begin. But while lawyers argue, prices explode upward as every industrial user rushes to secure supply. Default is not a single announcement. It's a sequence. Delays, excuses, partial deliveries, cash settlement, and finally market failure. We are already in the delay phase. FTD is next. And when it happens, Anyone holding paper claims, unallocated accounts, promises, or generic ETF exposure will be paid in dollars while silver trades far beyond their reach. That's why the rule has never changed. If you don't hold it, you don't own it. This outcome isn't speculation, it's arithmetic. A fractional reserve system always fails when too many claims chase too few ounces. The vaults are not empty of silver, they are empty of unclaimed silver. They are packed with metal that already has multiple owners on paper. When claims overwhelm reality, default is not a risk, it is the mechanism. And while default is an escape hatch for the exchange, it is a trapdoor for anyone holding paper. At that point, the failure to deliver is no longer whispered. It's visible, it's documented. The market splits in two. We enter the age of unobtanium. Unobtanium is an engineering term for a material that would be perfect. If you could actually get it, that becomes silver. You walk into a coin shop and the cases are empty. The dealer doesn't argue prices anymore. He just says, I can't source any. Wholesalers are dry. Mints are backlogged indefinitely. Online listings read like tombstones. Out of stock. No estimated restock. Pre-orders suspended. The ticker might still flash $50 spot, but beneath it, the truth leaks out. Buybacks at spot plus $25. Offers at spot plus $45. The premium has swallowed the price whole. The paper quote still moves, but it no longer matters. It's a corpse with a pulse. Real price discovery migrates to private transactions. If you own physical silver, real bars, real coins, you're no longer a retail buyer. You are liquidity. A monster box turns you into a micro central bank. People come quietly, friends, neighbors, small business owners. I need real money. Will you sell? And for the first time, you're not asking what the price is. You're deciding whether you want to sell at all. This is the moment the so-called crazy prepper is vindicated. The one who was mocked for stacking heavy metal is suddenly the only person who can transact. In the banking stress that follows a public FTD, cash access becomes unreliable. ATMs ration, cards fail, transfers stall, silver never does. It doesn't require permission, it doesn't need uptime. It is value, offline, portable, final. The institutions that positioned correctly understand this. Banks that flip long don't rush to save the market. They become the market. They ration supply to strategic clients and the highest bidders, big tech, defense contractors, governments. Everyone else is irrelevant. A two-tier economy emerges, those with access to real resources and those with digital claims. Accumulating before the vaults hit zero is how you cross that line. This doesn't stop at finance. It spills into geopolitics. When Western exchanges fail to deliver, rivals step forward with receipts. China and Russia reveal hard asset reserves and say, we have the metal. Confidence in the dollar erodes faster. Trade moves toward hard settlement. Empty vaults in New York and London become symbols of decline, like empty granaries before the fall of past empires. Eventually, price does what suppression never could. It forces supply to respond. At triple-digit silver, marginal mines reopen. Exploration restarts. Scrap gets melted. But that response takes years. The window between default and supply recovery is the supercycle, the phase of extreme scarcity and brutal wealth transfer. 3 to 5 years where silver is not an investment thesis, but a strategic asset. In that window, silver buys freedom. It bypasses frozen systems. It lets you acquire assets from distressed sellers who need certainty, not promises. The danger is no longer price volatility. The danger is counterparty collapse. ETFs rely on custodians. Futures rely on exchanges. Unallocated accounts rely on banks. When vaults are empty, those structures are hollow. The only asset without counterparty risk is the metal you hold, the coin in your hand, the bar in your safe. It doesn't default. It doesn't require trust. It simply exists. The empty vault's reality is the final act of the suppression story. First, dilution through paper, then ridicule, then obscured inventory. But physical truth cannot be negotiated. When the vault runs dry, the game ends. So the question is simple. Do you own silver, or do you own a promise to deliver silver? If it's a promise, redeem it. If redemption isn't possible, exit it and acquire the real thing. Because when the music stops and FTDs go public, promises evaporate, and metal becomes priceless. The vaults are draining, the trucks are rolling, time is running out.